Hello everyone, welcome to this weekend options talk number 15 between me and Raghunath. Last week Raghunath was away and he had a good holiday and Prashant had come in between. But now we are back to our normal schedule. So coming straight to charts, which I always do. Though Nifty has closed on a quite a bearish note on Friday in terms of candlestick, everyone is looking at the bearish engulfing weekly candle. Let me just quickly go through the Nifty charts and various charts to see whether that bearishness is really reflected in these charts. Coming to a chart of Nifty on a typical Nifty 50 spot chart on a point 0.1, which is a standard box size. It has given a double bottom sell, but this double bottom sell is above the moving average, and the moving average is right at the place where Nifty is right now. So there is a support. Only thing is, if it goes below 11, below the moving average, so any close below 11, 330, 300 will be bearish. So that you need to keep in mind. So it is right on the border right now. Now, if you come to the Nifty futures intraday chart, which is always on a 1 minute chart, this also has given a bearish breakdown on Friday, second half, and the count on that is 11,172. In fact, if you see the anchor column which happened after 2 o'clock on Friday, that count is at 11,172. But again, you'll see those horizontal dotted lines. What are that? That is called an anchor point. Anchor point is typically drawn from big swing highs and lows. So this is the swing low near 10,900, which happened, which is basically the last month's low, and the recent high. So if you select these 2 points, the anchor point comes to 11,300, 320. So same area once again. An anchor point means nothing but the place where within this swing, more number of X's and O's are on this chart. So that is the band where most of the activity has taken place. That's why this is extremely important. And any close below 11,300, that means trouble. So that one needs to keep in mind. Even if it goes below 11,300 intraday, it has to go up and close above 11,300, preferably above 11,330 on Monday. Now, if you look at the Bank Nifty and Nifty ratio chart, which has been outperforming over the last few weeks. In fact, I had mentioned this quite a few times. This has been the villain. In fact, this has given. This is again an intraday chart on a 1 minute chart on a 0.1% box size. This has given a bearish formation on Friday itself. But what do you see from the lowest point? There is a 45-degree trend line, which is a can act as a good support, and this also as a has a 50% fib retracement. So this point, which is in fact the lowest on Friday afternoon, and this 45-degree trend line, these can act as a good support going forward. So that's why Monday is going to be quite a sort of a do or die level for the market. If you look at the 11,300 put, which is the at the money sort of put on a monthly expiry, this looks bullish, no doubt, but it is approaching a resistance near 230, which was formed on Monday. That high has not yet been crossed. So this high of 230 can play a role. I mean, it can act as a resistance on the 11,300 put. And if you look at the 11,300 call, and a lot of regular listeners will remember the same 11,300 call which I was tracking for August expiry. Now, as luck would have it, that is again coming into picture on in the September expiry. So this is of course definitely a bearish action, but again this is approaching support near 200, 230. So basically 230 is a level on the 11,300 call as well as the 11,300 put. One is the resistance, one is the support. So if 11,300 call does not close below 200, 200, 210, that can act as a support. I'm not saying market will run away immediately, but these are the levels which one needs to watch out for. And if you see some base formation on near those levels, that is an indication that Nifty is likely to turn. Now, coming to a stock specific idea, last time we had Prashant and myself had talked about a lot of stocks. So, the best outperformer among them was Bharati, which gave this good column of X. Now this has come down, but it is still not completely bearish. Of course, this is not bullish also, But if you look at the 530 call, now that is approaching a support. This is a support near 15-16. Last week I remember, I'm not sure. Yes, I had given 530 call itself, which had gone from 17 to 35 in a matter of 3 days. Again, it is approaching the same level of support near 15-17. So this can be watched out for Monday onwards. And if it is taking support near this 15-17, this might give a same trade again this week. One chart which Prashant had mentioned on, last weekend, that in fact he had also shown the chart of the ATR, the volatility, and we had talked about that there can be a spike in volatility, and that happened. But looking at the broader market, this is the ratio of Nifty 500 upon Nifty 50. This is a ratio chart. This is still very strong. I mean, there are two big anchor columns right at the bottom, which is an extremely bullish sign. And the next time it gives a follow through double top buy. Right now, this level is at about 827. This is a ratio chart, and the follow through double top buy is 830. So any close above 830 on this ratio will be a big follow through buy, because you will see there is a big anchor column over here from 810 to 828. And this double top buy will be very bullish for the Nifty 500. So maybe next week onwards, mid caps might start outperforming once again. So this also has to be watched out. Now I have finished with the charts. I'll show you a few. I have a sort of a quiz this time. This is a mystery chart. This is a monthly chart of a stock. I want viewers to just give their opinion whether this is a bullish chart, bearish chart. That's all in the comments on the YouTube channel. So this is a monthly chart of a stock. The averages are 200, exponential and simple. So just look at this chart and say whether this is a bearish chart or a bullish chart. Now there is one more. The same stock. This is a same chart, same stock on a pointed figure 3% chart. So you have a big 45-degree trend line from a long-term level, and this is also approaching support. So again, whether this is bullish or bearish. So basically the same charts on two different chart patterns. You have to answer whether this is bullish or bearish, and the same stock on a 1% box size, which is a medium term. So this is the third slide of the same stock. One was the candlestick monthly chart, one was the point and figure 3% chart, and this is the point and figure 1% chart, which is the medium term chart. So based on these three charts, you need to tell what is your opinion of this stock, whether it is bullish or bearish, and write it on the comments in the YouTube channel, and let's see how many of you can guess it. So that's all from my side. Raghunath, you have any questions, or I'll make you the presenter?
Yes. I have some comments and some questions. Looking at very interesting charts this week, because a confluence of charts show that it will be a make or break situation for the market.
Yes.
In the short
Absolutely.
term. And one more thing is that I saw a recent signal in Maruti. I think it's a double top buy. What is your view on that based on the charts?
You mean the
Maruti futures or options, whatever you would like to show.
1 minute.
Maybe FNO?
No, I'll just look at the EOD chart first. Yeah, this is definitely bullish on the basis of EOD. Now, if I look at the futures chart on a 1 minute time frame, which is a very short term time frame, but that is very useful to identify the. This is also definitely bullish, no doubt about that. Yet, in fact, there was a huge anchor column on Friday, though Nifty opened gap down. Maruti was the biggest front. The outperformers on Monday.
Yes.
It shot up straight from open and went all the way from almost 7,000 low to 7,000. I think something like 300 points from the low. So as long as this low of, as long as it protects 7,000, Maruti is bullish. That is my view.
Okay. Thank you, AP. Now I will take over.
Okay, I'll make it a presenter now.
Yeah. Hello, folks. Welcome to Options Talk. So this time, so last few weeks I talked about three Greeks. One was delta, gamma, and theta. And as I said, I will this week talk about another Greek, option Greek, Vega. So these are standard disclaimers. So if you look at an option pricing formula, there are 5 variables, which means 5 inputs, which are used to determine the pricing of an option, whether it could be call option or a put option. And this is based on the Black-Scholes formula. Now let's look at what are these 5 variables. So one is the current stock price or current underlying price in this case. And the next one is the strike price of the option. And the third one is days to expiry or time to expiry. The fourth one is the risk-free rate of interest. And the fifth one is the expected or the implied volatility of the underlying stock over the life of that particular option. So these 5 variables are important to determine the pricing of the option. With this in mind, so again I listed all those 5 variables here which determine the option's value. Now let's look at an example where we look at 2 stocks which have like similar pricing, and we look at the call strike and put strike of the same strike price. In this case, it is a 150 strike. Now, if you look at stock 1 and stock 2, they are very similar underlying price. But if you look at the option pricing, which is shown in brackets, the option price for both call price and put price is much higher for stock 1 compared to stock 2. And let's assume that they belong to the same expiry. Now, if you look at these inputs, okay, is the underlying price is different? Very slightly different, but it might not have a huge influence on the options value. Is the strike price different? No, strike price is same. Is the time to expiry is different? No, it's the same, because we are saying that it's of same expiry. And interest rates are different? No, because the interest rate will be the same for all the options. So the only one variable is there here which is different for these options, and that is what is influencing this different option pricing, and that variable is volatility. So volatility component of options values is called implied volatility. Okay, this variable or this input is called implied volatility or the volatility component of options value. Now, IV is the value entered in the Black-Scholes pricing formula to derive options theoretical pricing, right? I've showed you the formula in the first slide. So that is the input that we enter. Implied volatility is the input that we enter in the Black-Scholes pricing formula to derive options theoretical pricing. This is one of the input, of course. The higher the IV input, higher the options theoretical value, assuming the other variables are constant. When IV of an underlying changes, the option prices also change accordingly, right? Because if you look at the example that I've given, because of the volatility difference, you see different option pricing. So that is what the this point emphasizes. The relationship between changes in IV and changes in options value measured by an option Greek called Vega. So that is the definition of Vega. The relationship between changes in IV and changes in options value is called Vega, is defined by Vega. Now let's look at a detailed example. So Vega, to define it more thoroughly, Vega is the change in theoretical value of the option for each 1% or 1 point change in the implied volatility. if IV changes by 1%, the theoretical value of the option changes by the amount of options Vega. So let's take an example of a long call option. This could be any strike, or let's assume it's an at the money call option, and this has a value of around 5 rupees or 5. And if the IV increases by 1%, and if the value changes to 5.6, then we can say the Vega of that particular option is 0.6 because it increased by 0.6. So if I look at in percentages, then it is 60%. Okay. And similarly, if the IV decreases by 1% and the value changes to 4.4, then that option's Vega is same, right? If the the options Vega is same, and that is why if it increases by 1%, it changes to 5.6 or increases to 5.6, and if IV decreases by 1%, then the value changes to 4.4. So this will be the Vega of that particular option. Now the Vega is positive for long options, and this we call as long Vega positions. And for the short options, sorry, this should be negative Vega. It is a short Vega position. An increase in IV helps long option position as it increases the value of the option, thus increase the PNL. And conversely, the increase in IV adversely affects short options positions PNL. Correct? Because the value of the option decreases. A decrease in IV helps short option position as it decreases the value of the option and thus increase the PNL. And conversely, decrease in IV adversely affects long position PNL because it decreases the value of the option. So that is how the Vega affects the long positions as well as short positions. Now let's look at a real example. So here I took 11,300 call, which is like based on spot price. This at the money option. Now, if you look at the Greeks of this particular position, and if we look at in rupees, it says the Vega is 751 rupees. So this has a Vega of rupees 751. It means at that instance, assuming other conditions remain constant, like delta, theta, gamma remains constant, the option gains 751 rupees or 10 points because the lot size is 75. So 10 points. So the option gets 750 rupees for every 1% increase in IV and loses by same amount for every 1% decrease in IV. Okay. So tomorrow if the IV increases of that particular Nifty, then the value increases by 750 rupees for this particular option. Now let's look at the relationship of Vega and moneyness. Just like other option Greeks, Vega also changes and is not a constant, except for in one particular case. So the moneyness, time to expiration, and volatility option all affect the Vega of the option. Vega of an option will vary depending on not only market conditions but also on its moneyness. That is whether it is in the money, at the money, or out of the money. Vega is greatest for the option when it is at the money and decreases when it is in the money or out of the money. The Vega of an option is direct function of time value that the option possesses. Because at the money options have the highest time value or the extrinsic value, they have highest Vegas. Whereas out of the money and in the money options have lower time value and therefore they have lower Vegas. Now let's look at the option chain of the this is 24th September expiry option chain. And if you look at the money options and in the money and out of the money options for puts as well as call options, if you look at the money options, the Vega is around 1000. This is in percentage. And if you look at the in the money options for both the put as well as call options, it's around 700 to 800. And there's quite similar values with 600 to 500 for the out of the money options. So as you can see, at the money options have the highest Vegas compared to out of the money and in the money options. The reason being, at the money options have highest time value or highest extrinsic value. Now Vega and time to expiry. The days to expiration have a direct relationship to Vega. As the expiration approaches, Vega gets smaller for all options. Now if you look at this the curve of the Vega, if you can see here, the Vega is decreasing as we approach close to expiry. Now this can be attributed to high extrinsic value left in the at the money options, while lower negligible extrinsic value left in the money and out of the money options. Now these are at the money options, for example, we took. Another thing is that if you look, this is the September expiry and this is the October expiry. The near the money options will have lower Vegas compared to longer dated options. Same strike price but different expiries. The shorter term expiries options will have lower Vegas compared to longer dated options because of the same reason that they have a high extrinsic value. Now coming to Vega and volatility, what is the relationship? This we have briefly talked earlier. At the money strikes have similar Vegas at both high and low volatility. Now this can be little bit different from what other Greeks might have. Now I will tell you what is the reason for that. Now if you plot a chart of volatility on the x-axis and options value on the y-axis, right? If the volatility increases, the option value also increases, right? So it is a direct relationship. So it will be like a straight line. And if you take the slope of that line, that will give you the Vega. So and that for that reason, the slope remains same for the at the money strikes, whether at low volatility or even at the high volatility, because the relationship is linear. And for that reason, at the money strikes have similar Vegas at both high and low volatility. But for in the money and out of the money options, the Vega values are low at low volatility and increases significantly at higher volatilities. So now let's look at the example for the at the money strikes at high volatility as well as low volatility. Now this is the example of at the money strike, which is 11,400 call we took, and these are the inputs. And here at 20% volatility, you look at the premium, it's around 189 and 214, and the Vega is 1007. Now same example at high volatility, which is at 40%, double of this, and you see the Vega doesn't change for that the money strike. All other values change. Theta changes, but gamma changes and theta changes, but the Vega doesn't change. Of course, delta will not change. So look at this relationship. So for at the money options, it doesn't matter volatility. The Vega will remain same, whether it has low volatility or high volatility. But if the volatility increases, the increase in Vegas is the highest for out of the money and in the money options. So keep this in mind. So that is all from me for the Vega Greek. If you have any comments for both APs as well as Vegas, please leave in the comment section and tweet to us or email us. Thank you, folks. That is all from us, unless AP has some questions.
No, that's all.
Thank you, folks. Goodbye.
Thank you. See you next week, next weekend.